Hello, class. This is chapter 10 of the personal finance text titled Personal Risk Management and specifically about insurance. Life is full of risks. You can try to avoid them or reduce their likelihood and consequences, but you cannot eliminate them. You can, however, pay someone to share them, so share the risk. And that's the idea behind insurance for those what ifs in life. There's a couple different types of risks. First, you have speculative risk, which can be avoided simply by not participating and is almost always uninsurable. Then you have pure risk, you can try to avoid them, and then risk sharing, you can pay someone to share them. And that's the idea behind insurance. Risk shifting equals insuring, and then you can insure property, health, and income. Learning objectives for this section describe the purpose of property insurance, identify the cause of property damage, prepare the kinds of homeowners insurance coverage and compare the kinds of homeowners insurance coverage and benefits, analyze the cost of homeowners insurance, compare the kinds of auto insurance to cover bodily injury and property damage, explain the factors that determine auto insurance costs, and analyze the factors used in determining the risks of the driver, the car, and the driving region. So here we have property risks. The risks that you have is loss or use of value and also liability. When it comes to property risk, then it further subdivides. So from the loss of use or value, you have hazards, vandalism, and theft. Theft is self-explanatory. Someone comes in and robs you. Vandalism, someone does damage to the inside or outside of the house, or hazards. And then you have liability risks, which is personal injury and property damage. Property risks is specific to home and your auto. For your home, you can have owner's insurance or renter's insurance. The owner insurance can cover the structure and your possessions and listed property. And then the renters can also do that, but it doesn't necessarily cover the structure, but it does cover your possessions. So a lot of renters insurance companies, like Assurant, for example, they'll cover you up to like $100,000. They're popular in the South Florida region, and if let's say a hurricane comes by and your computers get wet, your possessions can be insured under that. What's covered? Fire or lightning, windstorm or hail, explosion, riot or civil commotion, damage caused by aircraft or vehicles, smoke, vandalism or malicious mischief, theft, volcanic eruptions, falling objects, weight of ice, snow, or sleet, accidental discharge or overflow from water or steam, or damage caused by steam or freezing. You do want to be careful though, and make sure you know what's covered under your insurance, because I know there's in Florida, for example, there's some areas in Central Florida that won't cover you for flood, or they won't make it mandatory, and it's all based on their risk assessment process also. If it's highly likely that, for example, the home that you have will definitely get flooded at some point, it might not be financially feasible for that insurance company to insure you, so they might deny the coverage. What's not covered are animals, property of renters, or property kept in an apartment regularly rented, which depends. If you have property insurance like Assurant, they might. Business property, even if the business is conducted on the residential premises, which is, depends. If you work from home or something like that, and you use your equipment to work, I'm pretty sure that they'll also cover flood and then earthquake. Insurance benefit, actual cash value, or you have replacement costs as well. And through replacement costs, you have guaranteed replacement costs and extended replacement costs. So here are some things that can be insured. You have insured property and coverage, um, employment, marital status, criminal record, credit history, and insurance claim history are all considered when you're being insured. Um, as far as property is concerned, age, size, location, proximity to fire, police services, building materials, number of occupants, and heating system are all considered. And as far as coverage is concerned, actual cash value, replacement costs, endorsements for listed property, umbrella for personal liability are all considered. And then we have discounts. This should have been all in one slide. Sorry about that. I apologize on behalf of the publisher of this text. So you have under discounts multiple policies with the same insurer, fire extinguishers, sprinkler systems, burglar and fire alarms, deadbolt locks and fire safe window grates, long time policyholder, upgrades to plumbing, heating, and electrical systems. So these are all things that might grant you the ability to get discounts with your insurance. Since if you have a fire extinguisher, for example, the likelihood that your place will burn down if your home is less because you can extinguish the fire. So these are things that they consider minimizes the risk of them having to pay you out more. So that way they'll give you a discount. So it entices you to go with them and not with someone else. Insuring your car. We have bodily injury, which is bodily injury liability. You hit someone. Medical payments. Uninsured motorist protection also. And then we have property damage liability, collision, comprehensive physical damage. So that's mainly the two biggest areas of car insurance, bodily injury, and then property damage, which is damage to the car. So then it elaborates a little further. Bodily injury liability is injury to people not in your vehicle. Medical payments is injury to people in your vehicle, right? And then you have under property damage liability, damage to someone else's property. If you crash into another car or into a house, hopefully you won't. And then you have collision damage to your car. So here you have the insurance cost. Um, and then as a subset of that, the car, the driver, and the driving environment. As far as the car is concerned, what's important is the model, style, age, and safety features of the car. As far as the driver is concerned, you have age, the education. Sometimes you'll get like a discount if you're a student, so you might want to contact your insurer and see if you can get a discount since you all are students. Your gender also plays a role, your marital status, and your driving history. And the driving environment, accidents, theft, and vandalism also plays a role. Sometimes your insurance will change prices depending on what zip code you provide. And um, yeah, so then depending on the zip code that you provide, if there's a high likelihood that you might get your car stolen, then you might have to pay a little more. Now, what's interesting when looking at car insurance, now that I think about it, in comparison to, for example, the Affordable Health Care Act that was passed recently, the Affordable Health Care Act reduced, it helps to eliminate a discriminatory factor when it comes to insuring people. So now you can't discriminate based on pre-existing conditions. And now that just a thought that came to mind, it kind of seems that basing the cost on the age, the education, gender, marital status, and where you live is kind of discriminatory too. It's just a thought. Key takeaways. Property insurance is to ensure the rights of ownership and to protect against its liabilities. Property damage can be caused by hazards or by deliberate destruction, such as vandalism or theft. Homeowners' policies insure structures and possessions for actual cash value or replacement cost. An umbrella policy covers personal liability. The cost of homeowners insurance is determined by the insured, the property insured, and the extent of the coverage and benefits. Auto insurance coverage insures bodily injury through bodily injury liability, medical payments coverage, and uninsured motorist protection. Auto insurance coverage measures property damage through property damage liability, collision, comprehensive physical damage, and auto insurance costs are determined by the driver, the car, and the driving region or the driving environment. The risk of the driver is determined by demographics, credit history, employment history, and driving record. The risk of the car is determined by its cost, safety, and security features, and which may lower insurance costs. So depending on the number of airbags that you have in your car and whatnot. The risk of the driving region is determined by statistical incident histories of accidents or thefts. Ensuring your health, learning objectives. Define basic healthcare coverage and major medical insurance. Identify the insured's responsibility for cost. Describe the structure of health maintenance organizations. Distinguish the different accounts for private healthcare financing. Distinguish the different programs for public health care financing. Describe the standards of the Patient's Bill of Rights. Explain the goals of the Affordable Health Care Act, or also known as Obamacare, um, which has been coined that way, but it's called the Affordable Health Care Act, not Obamacare. And explain the purpose of long-term care insurance. So basic insurance, you got physician, surgical, hospital, and prescription drugs. Major medical are for serious injury or illnesses that may not just be accidents or something routine. Then you have dental, which is preventative, and then also other because you may have dental emergencies. So these are your costs and some key terms. Deductibles are an amount payable by the insured before any expenses are assumed by the insurer. The co-pays are a partial payment for certain costs, for example, for a physician visit or prescriptions. So this is just what you gotta pay, basically. And the co-insurance are shared payments of expenses by insured and insurer. So care. You have private, nonprofit, and managed care. Managed care are an example of this is health maintenance organizations, HMO, preferred provider organizations, PPO, which I'm pretty sure terminology has you've heard of it before. Exclusive providers organizations, point of service plans, and then traditional indemnity plans. So this is a breakdown. For the health maintenance organizations, the physicians are hired, no out of state network care, no out of network care, pardon, and then primary care physicians are the gatekeepers. So then in the preferred provider organization, the physicians are contracted and you have out of network care. In exclusive provider organization, physicians are contracted, there's no out of network care. In the point of service organization, physicians are contracted, there is out of network care, and primary care physicians are the gatekeepers. So basically, what this means is that whenever you go to the regular generalist physician, and sometimes we improperly call physicians are doctors because they've obtained that level of education, but for the purposes of this lecture, the correct term is physician. So when you go to your generalist physician, um, and whenever you have to get a prescription to go see someone else, like a dermatologist or a chiropractor or someone that has a very specialized area of medical practice, then you probably have the HMO, the Health Maintenance Organization. Okay. If you have PPO, then that's not the case. You can go straight to the through to the 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 specialist without having to go through your primary care physician or PCP as the gatekeeper. Insuring your health, private financing. Uninsured, you have self-insured, and then employer insured. So this is where your employer helps split the cost with you. You have flexible savings account or FSA. You can use this to buy medical stuff or some things at Walgreens, like my previous employer had that. Health reimbursement accounts, HRA, or health savings account. So this is the breakdown. FSA is funded by the employee. It does have an expiration, and contributions are not taxed. So money is taken out of your paycheck for this FSA account. You normally get like a gift, kind of like a gift card that you can only use for like medical expenses. And the idea behind that is it's pre-tax dollars, which is good because then you're able to use that money untaxed for medical related expenses. HRA is funded by the employer and expires when leaving employment. And HSA is funded by the employee. There's no expiration, and then contributions are not taxed. Very similar plans. Public financing. We have Medicare, Medicaid, different things. Medicare is for people over the age of 65. So if you're under 65 and you say that you have Medicare, you don't have Medicare. You have Medicaid. It's different. Okay. Um, Medicare, if you're over 65, Part A hospital, compulsory. You have Part B, which is medical. You have Part C, which is hospital and medical. Part D, which is for prescriptions, and then Medigap supplemental. So these are all the different components of Medicare for those who are over 65. Medicaid is need-based. Ensuring your health insurance regulations. So the Affordable Healthcare Act, Affordable Care Act of 2010 had some major goals, aka Obamacare, but we're not using that terminology here. Some of the major goals are minimize the number of uninsured, minimize the cost of healthcare for the uninsured, introduce benefits of competition into insurance markets, and guarantee minimum standards for insurance coverage. The Patient's Bill of Rights of 2010 has some major provisions, so children cannot be excluded from healthcare coverage due to a pre-existing condition, so they can't discriminate. Children can, because a health insurance company who has to work with, for example, a child who has insulin-dependent diabetes, that particular health insurance company is going to have to pay out more. And as an insurance company, they don't want that. They want to take money, but they don't want to pay out. So right now they can't discriminate on pre-existing conditions, which they used to do before. Who knows if that's the case now? Only time will tell. Children can be covered under a parent's health insurance until the age 26. Claimants can appeal coverage decisions made by insurers. There can be no lifetime or yearly limits on coverage for a specific condition. The individual's choice of doctors must be protected, and preventative emergency care must be covered. And healthcare premiums must be used mostly to pay for healthcare costs. And this is something that does carry a lot of controversy in the political arena right now. My hypothesis is that the way the country's healthcare laws have evolved for the last century, and in comparison to how other developing nations are doing, I foresee us possibly having a national healthcare system eventually. Not any time within the next 10 years or so, but I think we're getting to that point. Long-term care benefits, medical and ADL. You have indemnity coverage and then cost insured. The costs are based on the age, coverage, health, and inflation indexed. So this is a macro factor beyond your control. Key takeaways: basic healthcare coverage is for physician expenses, surgical expenses, and hospital expenses. Major medical insurance extends basic insurance in case of serious illness or injury. Insured responsibility for costs can be structured as deductibles, copays, or coinsurance. Health insurance is sold through private insurers, nonprofit service plans, and managed care organizations that may be structured as health maintenance organizations, preferred provider organizations, exclusive provider organizations, point of service plans, and traditional indemnity plans. Private healthcare financing may be supplemented by FSAs or flexible spending accounts, HRAs or health reimbursement accounts, and HSAs, which are health savings accounts. Public healthcare financing is provided by federal programs such as Medicare and Medicaid. The Affordable Healthcare Act and the Patient's Bill of Rights are designed to require health insurance to provide minimal standards of coverage, create insurance markets that are more accessible, informative, and competitive for consumers, decrease the number and the cost of uninsured, long-term care insurance providers for the cost of assistance with activities of daily living. Describe the purpose, some learning objectives. Describe the purposes, coverage, and cost of disability insurance. Compare the appropriate uses of term life and whole life insurance. Explain the differences among variable, adjustable, and universal whole life policies and the use of riders. And list the factors that determine the premiums for whole life policies. Ensuring your income. You have disability insurance and life insurance. The cost of disability insurance is determined by the waiting period, the amount of benefits, duration of benefits, the cause of disability, payment for loss of vision, hearing, speech, or use of limbs, inflation adjusted benefits, and guaranteed renewal or non-cancelable clause. Some optional features: disability due to accident or illness, loss of vision, hearing, speech, or the use of limbs regardless of disability, benefits that automatically increase with the rate of inflation, guaranteed renewal, which ensures against losing your coverage if your health deteriorates. What do you want it to do? Pay off your mortgage, put your kids through college, provide income so that your spouse can be home with the kids, not be forced out into the workplace, provide alternate care for your elderly parents or dependent siblings, cover the cost of your medical expenses and funeral, or avoid estate taxes. So you have term and whole life insurance. Term considered an insurance, and then whole life, which is an investment and an insurance. Whole life, with whole life insurance, you have straight, variable, adjustable, universal. Variable has minimum benefit, adjustable has adjustable benefit, and the universal has adjustable premium and benefit. Now here we come to riders and settlement options. Um, for under riders, it's a waiver of premium payment if the insured becomes completely disabled, a double benefit for accidental death, guaranteed insurability allowing you to increase your benefit without proof of good health, cost of living protection that protects your benefit from inflation, accelerated benefits that allow you to spend your benefit before your death if you need to finance long-term care. And then here for settlement options, you have lump sum, all the money all at once, in installments, which is over time, as interest payments until a specified time when the benefit itself is paid out. So when you have less life insurance, you have a larger asset base, more earnings from capital, and then less earnings from labor. And if you have more life insurance, you have a smaller asset base, less capital, less earning from capital, and more earnings from labor. So it's like a trade-off to consider. Key takeaways of insuring your income. Disability insurance insures your income against an accident or illness that leaves your earning ability impaired. Disability insurance coverage and costs vary. Life insurance is designated to protect dependents against the loss of your income in the event of your death. Term insurance provides life insurance coverage for a specified period of time. Whole life insurance provides life insurance coverage until the insured's death. And whole life insurance has a cash surrender value and thus can be used as an investment instrument as well as a way of shifting risk. Variable, adjustable, and universal life policies offer more flexibility of benefits and premiums. Riders provide more specific coverage. Premiums are determined by the choice of benefits in riders and the risk of the insured as assessed by medical history and lifestyle choices. And this concludes a presentation for Chapter 10 of the Personal Finance text. As always, if you have any questions, comments, or concerns, please let me know via email and I'll be more than happy to assist. Thanks and have a great day.